If you'd bought one Bitcoin in 2010 at 6 cents and held it to 2021, your return would be over 1,000,000 times your money. But here's the real question. Would you have held? You'd have had to survive 4 separate 80% crashes. That's the story of crypto. Let's define our terms. A crypto asset is a digital asset whose ownership is recorded on a distributed ledger secured by cryptography. There are 4 main flavors: utility tokens, security tokens, governance tokens, and NFTs for unique digital items. The market hit $2 trillion in 2021 before crashing to $800 billion. The lesson is simple. Caveat emptor. Buyer beware. The origin story starts in October 2008. An anonymous person named Satoshi Nakamoto posted a 9-page white paper. The Genesis block included a headline about bank bailouts. It was a political statement, a response to a crisis of trust. Satoshi's identity remains unknown. Their public key holds over 1,000,000 bitcoins, worth tens of billions today, untouched. Why did Bitcoin succeed where earlier digital cash failed? It solved the double spend problem without a central authority. Satoshi created a time-stamped, distributed ledger, the blockchain. Every transaction is visible across 46,000 nodes. Blocks are chained using ch5 hashing. It's a one-way function that makes tampering practically impossible. But there's a trade-off. Bitcoin processes about 2.5 transactions per second. Visa handles 24,000. Scaling is the core challenge. So who verifies these transactions? Miners. And mining is essentially a high-stakes game of random number guessing. Miners search for a nonce that produces a hash starting with specific zeros. The first one to find it wins the block reward. The reward halves every 4 years. It was 50 bitcoins in 2009, and it's down to just 3.125 after April 2024. As rewards shrink, transaction fees must replace them. Users literally pay to cut the line in the mempool fee auction. The environmental cost is real. At its peak, mining consumed 200 terawatt hours per year, more than many countries. There's also concentration. 75% of hash power sits in a handful of pools, which can lead to collusion and higher fees. The alternative is proof of stake. Instead of burning electricity, validators stake cryptocurrency as collateral to verify blocks. In 2022, Ethereum completed the merge, cutting its energy use by 99.95%. Bitcoin, however, will not follow. Bitcoin being open source meant anyone could fork the code. By 2021, there were over 17,000 different coins and tokens. Hard forks like Bitcoin Cash were essentially community divorces over technical disagreements and block sizes. Then came the ICO boom. From 2014 to 2018, these initial coin offerings raised over $20 billion with no oversight. The problem? Studies estimate 80% of 2017 ICOs were scams. The SEC eventually stepped in to shut the market down. The SEC used the Howey test to declare these tokens were securities. They even launched a fake ICO as a warning. A wallet doesn't hold coins, it holds keys. Lose your private key and your coins are gone forever. 20% of all Bitcoin is lost. Exchanges are honeypots. When Mt. Gox collapsed in 2014, 850,000 Bitcoins were stolen. Not your keys, not your coins. Which brings us to FTX, the most spectacular collapse in history. Founded by Sam Bankman-Fried, it was once a top exchange. The structure was circular. FTX lent customer funds to Alameda Research using its own FTT token as collateral. In November 2022, a balance sheet leak triggered a bank run. Within days, a $9 billion hole was revealed. Bankruptcy followed. $1 billion in customer funds vanished. SBF was eventually convicted and sentenced to 25 years in prison. What does research say? First, trust is broken. Early on, 25% of transactions were linked to illegal activity. The stigma remains. Second, Bitcoin cannot scale. Structural limits make it fundamentally unsuited for a global payment system. Third, volatility is a feature, not a bug. The system oscillates between booms and busts disconnected from fundamentals. But look at the returns. From 2011 to 2018, crypto averaged 20% monthly versus less than 1% for stocks. However, the Sharpe ratios are nearly identical. You get paid for the risk you take, but no more than that. What drives returns? User adoption and attention. Google searches for Bitcoin can even predict returns weeks in advance. Synthesis. Satoshi's technical achievement solved the double spend problem, but the institutional layer reintroduced the old frauds. Remember 3 numbers: 21 million cap, $20 billion raised in ICOs, and 99.95% energy savings with Ethereum. Bitcoin probably isn't money, but the underlying technology, blockchain and smart contracts, may still transform finance. That's exactly what we'll explore next in Chapter 6 as we dive into Ethereum and decentralized finance. See you there.